Hello, and welcome back to DoubleLine's Channel 11 News. I'm Ken Shinoda, your host today, Wednesday, June 2nd. May started off with a new high in the S&P 500 and a brief sell-off that brought back the sell in May and go away mantra of yesteryear. But only for a moment, as the calm of April appears to be back. Long-term interest rates have stabilized for now, and equities continue their slow grind higher. Transitory and taper were hot topics as market participants and talking heads in the financial media debated the potential for inflation to persist and the Fed to taper its balance sheet purchases sooner than expected. Or if these inflationary pressures are transitory and the Fed can continue its asset purchases and low interest rate policy for longer. With some subsiding fears of runaway inflation, the rotation out of growth tech and megacap into value seems to have taken a breather. The market is in a consolidation mode as we enter the summer doldrums. I have a feeling this summer may be slower than most, as workers that may be heading back to the office post-Labor Day head out on long-needed and overdue summer vacations. With the broader indices back towards their highs, especially in the U.S., and interest rates still low on a historical basis, what now is surely on investors' minds. The investment bargains of 2020 are no longer around. Asset allocation is top of mind as we head into the second half of the year. While U.S. equities have outperformed and certain pockets look expensive based on valuation metrics, relative value can still be found. Should investors continue to look towards value that has lagged growth for more than a decade? How about non-U.S. equities and emerging markets? With a weakening dollar, perhaps these are interesting markets to diversify into. Bonds, which have had a negative correlation to equities, providing a robust hedge for almost the last 2 decades, have started to behave with a more positive correlation. They historically have not provided the same safety when inflation runs hotter. Are we in a new regime for fixed income? Is the inflation we are witnessing today truly transitory? Given valuations in public markets, should investors be looking more to alternatives, real assets, private markets, or even cryptocurrency as a hedge to the endless monetary printing of developed central banks? Here to help me answer these questions and more is Seth Yablonovitz, Managing Director at Windmark Investment Partners, who provides customized consulting and outsourced CIO services to an exclusive roster of institutional clients. Welcome to the show, Seth. Hey, Seth. Welcome to Channel 11. Thanks for joining us today. Before we dive into some of your thoughts on the market, maybe you could tell the audience a little bit about yourself and your firm, Windmark.
Hi, Ken. Thanks so much for having me. I'm Seth Yablonovitz. I'm Managing Director at Windmark Investment Partners. I've been here for about 15 years. My role in the firm is to do a little bit of everything from managing client relationships to thinking deep thoughts about the markets and how portfolios should be positioned in response.
Great. Well, it's been quite the last year and a half. We had a record drop in stocks, a record rise. Here we sit with equities at all-time highs, bond yields very low, and I guess what I think the question on many investors' minds is what now? What to do now with valuations high? So I know you've prepared some thoughts and some slides. So I guess I'll turn it over to you to tell us about how you guys are approaching asset allocation in today's marketplace.
Yeah, fantastic. The Chinese say, may you live in interesting times, and I would say that we are certainly blessed with interesting times here. Why don't I share my screen and we can go. Why don't we take a look at the big picture here? This is a chart of interest rates going back 171 years. Basically, to the first Bank of the United States that was founded by Alexander Hamilton back in 1790. With the Funding Act, basically the United States governments assumed the state's debts and issued 10-year treasuries in order to form a more perfect union. And so we can see here that those bonds, they were issued and they started trading at a yield of about 8.7%. They dropped to just under 5%. And we can see that the 1800s, at the time, these yields seemed very volatile, but it was nothing compared to what we would see here in the next century. During World War II, the Fed and the Treasury pegged interest rates at what was considered to be extremely low levels. And they held it here well past the end of the war, out of fear that there was going to be a deflationary cycle as the war machine ended after World War II. They allowed rates to trade freely about 6 years after the end of the war. And what we saw a few years later was the great period of inflation. And so we can see this dramatic increase in 10-year yields. And the Fed funds rate actually topped out at around 20% here in 1981. And what we've seen since then is a dramatic and secular decline in interest rates. So why don't we take a closer look at this? So this chart goes back to 1954. What we see here is the Volcker era. And so Paul Volcker came in and basically increased interest rates in order to kill the inflation monster that was released in the 1970s. He was highly successful at it. And so this created a very deep recession here in the early 80s. But we saw a boom starting in the mid-1980s, and what has effectively and with few interruptions continued until this day. What we see in this chart here is actually really interesting. This is a period going back about 40 years where the Fed basically adopted a standard playbook, and that standard playbook is, for all intents and purposes, still at work today. And the playbook consists basically of lowering interest rates to consecutively lower levels. And so we see lower lows and we see lower highs. This is the story, in a way, of the past 40 years of the leveraging up of American society. What we saw in 2008 was during this crisis, interest rates were lowered down as far as they could go, down to zero. They hit that lower bound. And so what did the Fed do? Was they resorted to alternative means of creating liquidity. And so they resorted to what was previously the unthinkable. And this is basically the quantitative easing, the printing of money. And this became the standard playbook. And so we saw QE1, QE2, and QE3, and we can see, the increase in the balance sheet throughout these consecutive operations. And then what we saw during the COVID crisis was QE4, and just an absolute massive increase in the Fed's balance sheet. And so what we see here is a dramatic increase in the Fed's liabilities. We see an incredible increase in US broad money supply as measured by M2. But what's amazing here is that this had a very, very different effect than what it has had in previous decades. Whereas in decades past, an increase in the money supply of this type would have created significant inflation, almost a 1-for-1. So a 25% increase in M2 would have been expected to have created a 25% increase in nominal GDP. Things are working very differently this time around. And we can see this here in the velocity of money. And so this is a chart of the velocity. We can see how the velocity of money has absolutely collapsed. And so what that means is
it's finally picking back up.
It is finally picking back up just a bit, but nowhere near levels that it has historically and traditionally been. And so what this means is as the Fed continues to print money, it's getting stuck. It's not circulating throughout the economy. And realistically, this money is getting stuck in bank reserves. And so it's simply not having the same type of impact on the economy that the Fed would like to see. And so what did they do this time around? This is actually very different than what we saw after 2008. After the 2008 crisis, the playbook was A, interest rates, and B, it went to quantitative easing. We have added a third leg to the stool this time around in terms of the fiscal response. And so we can see an incredible increase here, primarily in government debt. And so we see government debt now approaching 125, 130% some estimates of GDP. These numbers in previous decades were absolutely unthinkable. Rogoff and Reinhardt, they did a study post GFC, and they went back and they looked at a number of different examples of increases in government debt relative to GDP. And their findings were that once government debt hit around 90% of GDP, that created significant drags on overall growth. And this is important because this is going to play into the inflation story and what we see as appropriate portfolio positioning relative to the inflationary background. And this is going to play a key role. And so what we saw this time around was the government coming in, lowering interest rates, going back to the same playbook of quantitative easing, but also adding this fiscal response. And this is different this time around because instead of taking money, adding it to bank reserves, where it effectively got stuck and really leaked out into financial assets, this time around, money has actually been put into the pockets of regular people through both the stimulus checks and through unemployment benefits primarily. And so our view is that in the short run, at least, this is going to have a very different effect than what we've seen in the past, because there is an actual real multiplier to money that is given to regular people, because the propensity to spend for working class people is much, much higher than banks. So when banks find their reserves have increased, they're not necessarily going to lend that out. That money is not going to flow through the economy. But when people get a check from the government, that money is going to flow through the broader economy. And so our view is that in the short term, at least, there is significant stimulus that is going to be flowing through the economy in very, very different ways than we've seen in the past. And so then the question is, how is this being funded? And I think this is the $64,000 question. Part of it is basically through good old-fashioned MMT, modern monetary theory, whereby the Fed turns around and buys the debt that is issued by the Treasury. And so our view very broadly is that this is going to have significant inflationary impact in the short term. The longer term, in our view, is going to be very different. So this creates very interesting times in terms of portfolio positioning, because our view is that the short term is likely to look very, very different than the longer term.
Yeah, I really like the way that you laid it out, the history of the Fed, quantitative easing and interest rates. Many people are always so biased by, let's say, the last decade or the last 2 decades, or just their career. And for many investors out there, they have not really been in a regime of rising interest rates or inflation. I mean, real inflation, right? So greater than 3% CPI hasn't happened for quite some time. So I think here at DoubleLine, we kind of agree with you. The short term, the inflationary pressures are here. We like to be shorter duration. But the jury's still out on the long run. And it's funny, a lot of investors ask us about, is the inflation transitory? And this transitory term is thrown out a lot. And I ask them, well, what's the time frame? Define transitory. Everything can be transitory. Is it 10 years? Is it 5 years? Is it 6 months? So, I mean, do you guys have a view on, what's the short run for the inflation? Is it a year? Is it 2 years?
Yeah, absolutely. So when we think about timeframes, I think timeframes is one of the key differentiators among investors and investment styles. So when I first started my career back in the early 90s, I was a knife fighter in the pits. The time frame was minute to minute, second to second in a way. Business school about 10 years later, and coming out and really learning apprenticing and learning the art of institutional investing. And there's a lot of differences, but one of the main differences is time frame. And so my time frame as an investor basically widened from the very, very short term to the very, very long term. And it's interesting because it seems that the average investor and Wall Street broadly has a time frame that is very much somewhere in the middle. And I think when the street thinks about forward earnings and they think about, what's going to happen and what are they going to price in, they tend to be thinking out about a quarter. And I think the reason for that is that tends to be sort of the distant edge of the visible horizon. And so it feels like that is where most of the street lives. You can arbitrage that. And so you can either, set up your machines, you can co-locate them, with the stock exchange and be extremely, extremely short term. Although that's an arms race that seems to be sort of reached its conclusion at this point. And the other way that you can go is a longer time frame, and that is where we live. And I think that's very appropriate for the type of investors that we represent. And so our view tends to be in, call it the 3 to 5 year time frame. When we think about inflation, our view is that the market is sort of obsessed with inflation right now because that really exists sort of in the sweet spot of the market's time frame, which is, call it 3, 6, 9 months in that neighborhood, and it's fluctuating. And so our view is over the next, call it 3 to 6 months, maybe 9, maybe 18 months. We really don't know. There are going to be significant inflationary pressures. Now, the Fed has called these pressures transitory. The one thing that we know is that, especially when you look at the dot plots and you look at the Fed's expectations for forward rates, is that they are likely to be wrong and that they are going to revise them in the future. I do think that in this case, the Fed is correct and that inflation is likely to be transitory. And the reason for that is if you go back and, you think to when the crisis first started, toilet paper. It was impossible to get it. You were you were on Amazon, thinking I'm going to have to buy the industrial kind of toilet paper that they put in office buildings that come in the massive rolls because that was all that was available at the time. The fact is the supply chains normalized over time. How long did that take? 6 months in that neighborhood was for the supply chains to readjust to the new normal. And I think the view is this time around it's going to be fairly similar in that right now, the issue in terms of inflation tends to be associated much more with shorter term supply demand imbalances. So for instance, if you're looking to buy a used car, if you're looking to put gas in your car, if you're looking to get a restaurant reservation, it's not so easy these days because of this return to normal that we're going through. But the fact is, we will get there. The vaccination rates in our home state is just past 70%. And so we are well on our way. I was just in the mall the other day and the masks had come off. And so we are on that path. The issue is that our just-in-time supply chain system is not well equipped to these significant changes in demand over the short term. And so what we saw during the crisis was everybody basically locked down and they changed their life. Their life moved indoors and over Zoom. And so we saw shortages related to that. Now that the opposite is happening, where we're getting back outdoors and we're looking to go places and do things, we're seeing the opposite. We're seeing supply shortages in those types of areas. And I think that the market will eventually, they will cure those supply shortages. And I think, it's also very possible that not only does the market basically meet that unmet demand, but the market is actually likely to overshoot. So for instance, you have global suppliers. If you're looking to buy, a pair of shoes, if you're looking to buy a lot of different sort of normal articles of, of clothing or articles of your life, they're actually very difficult to come by because the supply chains right now are not functioning very well. And so what we're going to see, especially on the international side, is those supply chains are going to be put back together. They're going to ramp up production, and we are going to see what is likely going to be an overreaction to this supply shortage today. And this isn't just for sneakers and clothing. This may well happen on the energy side, on the oil and gas side as well. And so that is our view, is that over the short term, much of these inflationary pressures are based on unmet demand that will be met over time. And so when we think of short-term versus longer term, right now, we're likely to see inflation pressures, and not just because of the base effect, where we have deflationary periods rolling off from a year ago and inflationary periods rolling on. The BLS does a wonderful job of putting these charts together so you can see graphically, and you can really anticipate very well what those base effects are going to be. But there's going to continue to be supply shortages. However, over the long-term secular deflationary forces remain very much at work. So let's think about what those forces are. Number one, I would say, is this massive debt load that we are operating under. Now, from a personal level, many consumers, the savings rate has really exploded here. And so that is likely to be inflationary here in the short term because people are flush with cash and they're looking to spend that money. However, over the longer term, we as a society are aging. The Japanese are aging. Europe certainly is aging. And now it's amazing. We just saw the Chinese changed their 1 then 2 child policy to make it now a 3-child policy and beyond, because they've realized that they are now facing a demographic crisis as well. And so older people simply spend much yet less than those in their 40s and 50s who are at their height of their earnings power. They're simply not as swashbuckling when they enter into their retirement years. And we have that bolus of baby boomers that are headed towards retirement here in the US. So demographics, debt, and then the other significant issue is innovation. And this is actually a good type of deflation. So I remember, this was years ago, I haven't been in a Barnes & Noble in a number of years, but the last time I was there, I remember looking at a book on the shelf, taking off one of the best sellers, and the price on the inside of the jacket was $28. And I checked very quickly on Amazon, and if I just wanted to wait a day or two, I could have it at my house for $17. And, I did the same thing looking at razor blades in the pharmacy a year or two later. When you think about Moore's law and Wright's law, so Moore's law effectively says that you can double your computing power every couple of years simply because we get better at it. And Wright's law says that every time you double the cumulative production of a widget, the price of that widget goes down by a set amount. So say, take electric vehicle batteries, for instance. We are approximately doubling production of electrical vehicle batteries every year. And so what that means is that every year, the price of those batteries are going to go down. And I believe it's around 25 or 30%. And this is deeply deflationary, this type of innovation, but this is a good deflation. We are also likely to see, especially if interest rates ever normalize, we're likely to see a type of deflation that's not so good in terms of older line legacy businesses that have failed to invest and simply are unable to keep up with their more technologically enabled or nimble competitors. And those types of businesses are likely to fade out over time. It's really interesting. If you go back and you look at the original components of the Dow Jones Industrial Average from over 100 years ago, the only one that you'll recognize is General Electric. You had you had leather producers and cotton producers, those types of things, and they've all gone away. And that type of creative destruction is a very, very powerful, in fact, I would say a dominant force, because the level of creative destruction is actually accelerating year after year, because we continue to build on the shoulders of those who have gone before us. And for companies that are unable to keep up with that type of technological advancement and innovation, especially among their competitors, they're going to have a difficult time, and they are likely to fade out and go away. And that's another deflationary impact that we're going to be looking at. So bottom line is, our view is the short-term supply-driven inflation and shortages. In the labor markets, that's a perfect example, but they will normalize over time. And these longer-term secular deflationary forces are very likely to take over. And so, to your question as to when, that's that's what makes life so interesting, because that question is unclear, but the broader direction, seems to be much more clear as to where the economy is headed.
Yeah, I mean, I would agree with you in the long-term forces of deflation, the debt burden, the technology. I guess one of the things to really watch is wage growth. You know, we really need to see that pick up. There's slack in the labor market. But one thing you mentioned at the very beginning, I think, is the big unknown is the money that is going to the average person through stimulus to unemployment benefits. Will it actually get spent? Will that have that multiplier effect? Or is it getting saved? Has the consumer changed their behavior? So we really need to kind of wait and watch to see how robust that consumer spending will be, given it's such a big driving force in the economy. And I think that's what could take that transitory period. And is that 6 to 9 months, or is it 2 to 3 years of inflation at a higher rate, right? And as far as when to change positioning, it's not necessarily about where the inflation is, it's about where the price action is on bonds. And the fact that the markets generally look out to the future. They started rising before inflation started rising. Bond yields started rising in anticipation of that. So at some point, the yields will get to the point where it's going to be a buying opportunity in preparation for that inflation to go away. And that's the tough thing as an investor and a money manager, is to time that right, of course. So
that's the real key, is where is peak growth, and where is peak inflation? And like you say, is it 6 months? Is it 2 years? Our view is that we have effectively reset the economic cycle. And so let me actually go to a chart here. This is the way we think about, this is a broad framework for asset allocation. And certainly we think in terms of relative valuation. But from a broader perspective, where are we in the business cycle? This tends to be very much how we think about it. From a simplified perspective, we can see how we just sort of go around the wheel here. So this was March of 2021. Our view was that we were in the early stage, and what's amazing is how quickly we have gone from that early stage economic recovery here into the mid-cycle. We think we have shifted. And the reason for this is just the massive amount of fiscal and monetary stimulus. The vaccines have enabled this reopening. And our view is, at least in the short term here, inflation is really pushing this pie slice around the circle. And there's not a whole lot that is holding it back at this point. When we think about interest rates, if we go to the Fed dot plot, that dot plot is effectively here at around zero for the next couple years, really into 2023. And I think this is a real key slide here as well. And so the question is inflation, at least in the short term, going to force the Fed's hand? I think that the Fed is actually quite worried about the longer term deflationary impact of these secular factors. And so when the Fed says that they're going to stand pat and that they are going to tolerate periods of higher inflation because, they're at least how they term it is they're looking at, higher average inflation, over time. That's basically their way of saying that we have a massive debt burden. And the only way to deal with this debt burden is to effectively inflate it away. And so I do believe that they are going to tolerate higher levels of inflation in the short term. The question is, are they going to be able to stand the heat? Give it 6 months, give it 9 months, and give everybody sort of rattling the inflation cage. And is the Fed going to blink? And I think that's the real question right now. I think consensus is for the Fed to start talking about the tapering, at least later this year, potentially tapering towards the end of this year. And then actually raising interest rates in, call it late 2022, 2023. The real question is going to be, if inflation rates really do spike up in the short term, how is the Fed going to react? I think the one thing that we really have to focus on is consumer expectations. I was in Home Depot the other day, and there was a 10-foot long board of wood, and that 10-foot long board of wood cost $40. And I'm thinking, this is, I'm not an expert on, the pricing of lumber. But I was talking to somebody and they would say that, a year or two ago, that same board cost $10. And so right now, the mindset of the consumer is to basically say, you know what, I'm not going to build that deck right now. I'm not going to build that addition right now because things will normalize. And so what that's saying to us is that the consumer's inflation expectations continue to be anchored at relatively low levels, around 1-2%. I think what we really have to focus on is whether consumer behavior changes and whether people start to say, I should actually build that deck right now, because the fact is, a year from now, 2 years from now, who knows where lumber price is going to be? The only thing that we know is that they're going to be higher. So we need to spend this money today. We haven't seen that type of dynamic yet. But once we start to see those very long-term expectations of low inflation start to become unmoored, that becomes a different situation, and that is something I think the Fed is going to pay close attention to. We're not seeing anything like that today, but I think that's one of the key indicators that we really need to watch over time.